What if luxury homeownership in Orange County was more attainable than you thought? At Skyline OC, Orange County's tallest residential tower, you can own a designer-finished residence with resort-style amenities, breathtaking panoramic views, and a lifestyle designed for how you live, work, and invest. Whether you're building wealth through real estate or searching for your next home, Skyline OC offers exceptional value in the heart of Orange County with condos from the 600s to $3 million. Visit SkylineOCResidences.com and discover why now is the perfect time to own at Skyline OC. We got a good show for you guys today. Welcome back. As always, your host, Matty A, Mr. Breedwell, my co-host.
Hi, y'all.
You don't have a Louisiana accent.
I said, hi, y'all.
Oh, yeah, I was going to say.
Yeah.
You had a big shout out to the Louisiana boys. They've been some of our longtime listeners from the beginning that have turned friends. We've been to Napa. You've been to Louisiana multiple times hanging out with them.
Mm-hmm.
That's one of the things I love about the show. One of the reasons why I've been really reinvesting in my personal brand is, I mean, you and I became best friends because I was putting content out. You showed up at one of my events. I mean, some of my best investors, some of my best friends, some of my best mentors, some of my best deals. Like there's obviously, a double-edged sword with social media. But I think when you do it the right way, there's also so many cool benefits that come from putting yourself out there. I mean, we do this show. How many clients have you gotten over the years by people going, I like that Ryan Breedwell?
Hundreds.
I mean, it's one of the best ways that you get to really connect with people. And now more than ever, I think too, people like the unpolished, just be yourself, talk about what it is.
Yeah. I've been that way for a minute.
I was like, we know you're a little unpolished. Polished in the right areas.
Exactly. Where it matters, where it makes you money.
You guys had a good time out in Louisiana?
Oh, yeah. I've never been boat
Give me
fishing.
2 to 3 highlights that you could actually say on air.
I went bow fishing, which was interesting. I've never done that before. That was fun.
Man, that much you can't say.
Man, no, we just did a lot. I've never been out on the type of boat we went on before in the ocean, so we went ocean fishing. It was like, second you threw the pole out, you pretty much had a bite. We were catching big fish, so that was really fun. There was just a lot of shenanigans. Lots of fun, but the funnest thing I think I did was I've never been bow fishing, where we got in this little boat and there was like these LED lights all around it. And we left at about 8:30, 9 o'clock at night. And they got this bow and it has like a fishing rod attached to the front of it. And then a string attached to the bow. It kind of moves up and down the arrow, but it's kind of locked on there. And you gotta like see these fish. I mean, it's like a skill. And I'm like out there, I'm staring, I can't see a thing. Our guides are kind of trying to show us how to do it. And they're just pulling stuff. And I'm talking like 20-pound fish out of the water. And it was pretty incredible to watch. So that was probably the coolest thing. I was like, holy crap, this is insane. They'd be like, it's right there, it's right there, it's right. I'm like, I can't see it. Boom, pull it right out. So that was pretty cool.
A lot more fun. I'm not going to downplay my fun, but it was different kind of fun. I was hosting a bunch of 9-year-olds at a Roller King skating rink. So we were getting down on some rollerblades this weekend.
And cruise around like,
oh yeah.
And do the little.
Oh, I was shuffling. I was gigging. I was
four-wheelers or three or blades or wheels.
Four. Yeah. No, but I was on the blades. Yeah, we don't do the skates.
That's what I'm saying. The skates are classy.
Yeah, they are.
That you like lean and kick your leg out.
Well, we have a lot going on with earnings. And the S&P 500 is responding nicely. We'll talk about some of the winners. And a couple of these, we've got some nice holdings in. So we can share what you're seeing on that front. We also have some updates of the worsening housing affordability crisis. It is getting worse, and there's some data to back it up. We've got the job market and some revisions that have continued to roll in. I'm curious how the market is adjusting and digesting all of that information. The American dream continues to be a challenge for a lot of people. We'll talk about how that is shaping the way Gen Z and future generations are looking at investing and ownership. And big stuff around inflation data this week, with CPI and PPI tomorrow. Believe we'll talk about what your estimates and thoughts are around that.
Yep.
And we'll talk about a few of our favorite stocks that we recently have invested in, that also reported earnings. SpaceX is, well, I'm not even going to say ready for takeoff. It has taken off. And we'll talk about some estimated price targets that some of the largest institutions are thinking is going to be in the near future if you're looking to invest. Why don't we kick it off with, first and foremost, everything that's driving a lot of what's going on in the market right now is really one of two things. It's been earnings and it's been the Iran conflict.
Yeah, less and less the latter.
We heard today through back channels that the Iran conflict is getting closer and closer to a peace arrangement or a deal. This is coming from Pakistan. How much weight does that hold? Who fucking knows?
I would say more than Trump saying it at this point.
I mean, that's kind of crazy. We're taking Pakistan's
I'm just saying that
card a little bit.
I just think that they like care more. They have less of a fallback. So I think that them saying it is good. It's good that another Middle Eastern country is like, yeah, it's good. But I also think they've also said that before. So I don't know. I'm trying to be positive.
Yeah. I mean, I'm not holding my breath, but let's say that they do get this peace deal done. Is the market kind of already shrugged this off enough to where it's really not going to be that big of a needle mover? Or are we really going to see a big pop come from this agreement being solidified? How is the market really looking at these agreements, in air quotes, at this stage of the game? And is it really market moving at this point?
My opinion is it's mostly baked in. So there would be a pop, 1%, 2%, maybe even more, up to 3% on the major indices. You'll probably see a lot more on individual names than you will on the indexes. So you'll see small caps rally and a lot of the more rate sensitive names rally because that would take hikes off the table. Even though they're pretty much off the table with the jobs report from last week, which we can kind of talk about as well. But I think really the more scary thing for the market, or what it would move it more is down, is if there was like a heightening in conflict. But I think it would go down less than it has in the past, just like it would pop less on positive news than it has in the past. Because I think the negative sentiment is kind of understood, and the positive sentiment is already baked in and expected into the market. So I'm looking for just good news there, and then people to kind of shrug it off and move on. It would put oil prices down even further than they already have kind of come down and moderated around the high 70s, low 80s. So to me, that negative news is more of a drop scare than positive. I wouldn't like say, oh yeah, go load up for the rally after the Iran conflict eases. Although I would love to be wrong on that. I don't anticipate that.
Do we expect CPI and PPI to come in hot tomorrow in line? What are the expectations? And has the market kind of, staked their viewpoint in where money is at today? Or are we going to see some major reactions and responses tomorrow? Is the market already front run or based on these expectations, or what are you thinking?
Well, there's going to be some interesting talk tomorrow because I wonder depends on how the news people are feeling, because there's year over year and then month over month. Month over month is probably going to be higher than last month over month because we had a huge pullback from much inflated numbers. I think consensus on core and headline is a small bump, 0.1 and 0.4. But the year over year is the more important number in my opinion on both core and headline. I'm expecting core to come in somewhere between 2.3 and 2.4 or 2.5, excuse me, and headline to come in somewhere between 3.3 and 3.4. Those both are downtrending and would be continually trending down. And that is another good sign that although there's these little blips here and there left and right, the economy is still strong as a whole and moving in the right direction. I think the thing that can help that a lot and refocus people back on earnings, which is ultimately the most important thing and the biggest catalyst, in my opinion, for the week, is oil getting down lower, so inflation numbers are lower, so that people can just stop talking or even thinking there's going to be a hike. It's just like people betting for a cut at this point. It just is like, I mean, probably not.
Yeah, we have U.S. oil sitting at 83.24 a barrel right now. So spiked a little bit. I mean, seems like every other day it's kind of, we'll bomb them, the normal, right? And we'll bomb them. We're good. We're close to a peace deal. They want to talk.
It's just up only 1%.
But it seems like the volatility has gotten a lot less aggressive.
Mm-hmm.
That window has, maybe we're jumping. Where were we at last week on the show? It was like 76?
76, 77, and then we had an increase in conflict, and so we're back up to 80, 83, like you said, 82, 83, and that just is like, to me, that's not that big of a move. When we see it go from like 76 to 85 to 91 to 97 to 90, that's when you're like, okay, that's a big jump in the number, but $6 a barrel is not a big deal. And so to me, it just coming down would be good. But the volatility corridor is tightening on everything. You also can see that in gold.
Yeah.
Gold kind of hit a squeeze point and is kind of rallying there. But I was going to just say, pull the volatility index. It's trading in the teens. I mean, we really got to get high up there for it to be something to worry about. And it's trading at 15. And do you see how it keeps popping? But the pops are lower and lower and lower every time. That's my point on this volatility. It's just people are digesting things better and better and better. And that goes all the way back there. See that? There's the conflict starting.
Yeah.
Okay, people shrug it off. We're figuring it out. Oops, we're bombing the hell out of them again. Okay, peace talks maybe. Nope, shrugging it off. There's the last round. And now here's the last round of peace talks. And you can't even get close to those spikes in the back.
Right.
They're just not, the volatility is just not there anymore. So I think the market's pricing in that it's going to be pretty much solved here soon. But, ask Pakistan, because I guess they know the best of that right now.
Well, shit. I mean, so let's talk about how the market is kind of adjusting to all of these talks right now. So we've got the S&P 500 at 77.28 as of close today on Tuesday.
Yep.
And
about 12.4% year to date, I think.
And we've got
Almost.
some new price targets, which you mentioned in the previous episodes. Now I'm starting to see, I forget who it was. I'll pull it up in my notes here, but I think
Goldman Sachs said around 600, and we're talking about, of course, SpaceX here. Goldman Sachs said around 600. I think I'm looking around the 600, 615, somewhere in that range. That would be a good place to maybe start shaving off some and taking some profit. But I think it has a good opportunity to run there. They're back in the 130, 133, I think they're trading about right now. Above pre-IPO, or not pre-IPO, above IPO price. That's going to put confidence back into consumers and also FOMO into retail traders. So they'll come off the sidelines for that. So I'm feeling confident in the name long term. I think we have some ground to make up, but I'm pretty sure our entry point is somewhere in the 140, 160 range for our clients. So we're moving back up to that area, but we hold names like that, and another one we'll talk about here in a minute, CoreWeave.
Yeah,
for our clients that like to speculate.
Yeah, I mean, I got in on their pre-IPO on this one.
Oh my gosh, they're at 103. They're moving after hours.
And I was very, very happy overall just being involved in the stock early on, and earnings today. Let's see.
They missed on I think they missed on EPS. They had a bigger loss on their EPS, but their revenue was a beat. That's my remembrance. That's either opposite of that or it is that. But they're
a buy right now.
on technical indicators. Yeah, they are. There you go.
So based on the earnings report, they popped what, couple percent today, and then after hours, you noted
they're up like 13-14% right now. 110 is their looks like they're like upper resistance kind of area. So if it goes through 110, I would not be shocked to see that thing absolutely fly, even more than it already is, because that'll be a huge sentiment change. So CoreWeave,
what shifts the sentiment change where like companies, let's just use CoreWeave for example, let's say they break through that 110 ceiling like you're talking about. Like how do you identify those ceilings, and what are some of the catalysts that really push them through and keep them there to keep growing above and beyond?
well, it's kind of like it's when people start saying, okay, I'm going to buy this because I think it will. It starts being, oh yeah, it's consensus. It is doing XYZ now. So think of Nvidia before it was the AI chip giant that it is. Think of Apple before it dominated the computer software hardware space in the phone. Just before when it was smaller than Microsoft, it was really hard to get into Apple and behind Apple because it just wasn't a computer that was used everywhere. Right, the iPhone really is what took them to the place that they are and keeps them afloat now. So it's that kind of thing. It's like, oh, CoreWeave isn't a speculative play now. It is actually going to do this. And that's when you get people coming off the sideline. That's when you get funds that will put their money into it. That's when it gets really exciting because the stock price is around 100 now. It'll run and then you get a split, and then it'll run again and you'll get a split. And that keeps it, sexy and affordable for people.
Now, you mentioned SpaceX. Morgan Stanley gave a price target, bull case 600. Where did you guys have it at?
Around 600, 615, somewhere in that range.
Okay. And we bought what? We bought back at one.
I bought in for clients that were speculating somewhere around the 160, 140 range. I think it was spread between there. So we're still below our entry point that we initially got in.
Yeah.
We're pretty confident it'll be back there very soon. It's like, as we said, past 5 days, it's ran almost 30%.
And what has led to that increase?
I think investors finally offloaded the first lockup.
Yeah,
kind of went through. So I think investors offloaded. Technically, in a technical way, large institutions and retail traders are comfortable entering around that 130 number. The one, I think it was like 110, 112 number. And their earnings were good. I mean, they have a ton of cash on hand. They're buying companies. They're not, their PE, their ratios, if you go up and down the price to book, price to earnings, they're good. I mean, it's a solid company on paper. I think it's just taking people a little bit or a little while to figure out why this doesn't look like Tesla. But I think it does look like Tesla. If you remember owning Tesla in the early days, it was kind of choppy. And then it just finally people got it. Then it took off. I think that's what's exactly going to happen here with SpaceX. They're going to be like, oh, wow, they're putting satellites up. Oh, wow, they're going to put a base on the moon so they can launch from the moon to Mars and save themselves some. They don't have to, it doesn't have to have as much thrust to break off, from the moon. So it's just like a good, once people get it, just like people didn't get crypto and now we have crypto ETFs. Yeah. Like people didn't get AI. Now we have AI is more accepted. We both remember when people were saying, fear AI, don't let it into the market. And now it's freaking on everybody's phone and they're using it it's like a search engine, essentially. Now people use that as a search engine versus a regular search engine. And if you don't, your search engine company, which is likely Google, is using Gemini every single time you do research anyway.
Yeah.
So to me, it's inevitable.
It's the gradually then suddenly.
Yeah.
Right? Like it's just like that slow, and then all of a sudden it just is.
Look at electric cars. I mean, remember when having an electric car was so lame? It was like,
Now
oh,
they're
remember
fucking
those
everywhere.
Honda, like Honda electric one, and there was a Prius.
Bolt.
Just ugly, ugly. And then Tesla came along. They made it cool and sexy and kind of, I don't want to say created a cult following, but created like a group of people that believe in the brand, selling tequila on the side and just fun things like that. So I think that SpaceX is going to have that type of penetration in the market.
Hey, what's up, guys? I'm so excited to announce if you are an investor looking to generate consistent passive income, then I've got something for you. I just launched the Imagos Income Fund. It is a private investment debt fund. So instead of relying on long-term appreciation or big exit events like most real estate syndications do, we decided to keep it simple, focused on first position asset-backed lending just like a bank, meaning your investment is backed by real collateral and structured to produce income from day one. The target return, 10% paid out annually and also paid out monthly. So no guesswork, real passive returns, true mailbox money. And because we're in the debt position, not equity, we're able to prioritize downside protection, maintain shorter durations, and stay in control of the risk, which is most important in environments like this. This is built for investors who want steady cash flow, strong capital preservation, and real asset exposure without the headaches of owning, managing, and waiting years for a payoff. So if this resonates with you, if you want to learn more, I put together a full investor presentation breaking everything down. All you got to do is just text the word income to 844-447-1555. That's income to 844-447-1555. I'll send you everything so you can see if it's a fit for your portfolio. Let's talk about jobs reports.
Yeah, thank God they came out like they did.
Jobs have now been revised lower in 21 of the last 30 months by a total of 1,500,000 jobs, or 1,050,000, sorry. This means an average of 35,000 jobs have been revised out of the previously reported data each month over this period. June and May jobs numbers alone were revised down by a total of 103,000, which is the largest 2-month downward revision since July of 2025. What are we seeing in the job market right now? We saw ADP also reported this week private hiring in the U.S. has slowed for the 6th straight month.
This is good. This is good for...
If you want rate cuts.
If you want, well, no, if you don't want rate hikes.
Yeah.
I don't think it's going to pad the rate cut. I just don't think that that's on the table anytime soon. I wish it was. I just don't think it is. But I'd like to just have pauses if we can versus having to balance between a pause and a hike. It's just good for no hikes.
Yeah, I mean, I even saw this week that it said Kevin Warsh, this was an unusual Wales per Financial Times story that Warsh is reportedly prepared to support a rate hike in September. This was, I can't tell if this was prior to the jobs report that came out last week, but I saw this. I thought this was pretty funny. Somebody posted Kevin Warsh seeing Americans lose their jobs right now. Did you see this?
Oh, I love this dude.
This dude can get it. He got some moves. But obviously, Kevin Warsh, right, he's in a tough spot right now. You know, he knows obviously Trump wants him to cut. Everybody that is using any type of leverage or capital that is not their own cash and is borrowing wants to see money get cheaper. And that's really hard to, leverage in this current climate to get the returns and the spreads that many people desire for the risks that they're going to have to take when borrowing. It's obviously what's impacting the housing market. Which we have some updates on some pretty dire reports coming out on month-over-month sales and just the overall affordability of things. But this, obviously was a little bit of a meme, but I think it does, to your point, support the narrative that Warsh can kind of back off of this we're going to do anything in our power to get to that 2% number, which is a good posture and stance coming in to separate the Fed from the markets and saying like, hey, we're not going to be swayed by the president. We're not going to be swayed by what the markets are doing. We're going to look at the data. And when you've got a really strong job economy and you've got, a lot of the data that's been coming in with inflation starting to uptick again, those are a lot of variables that make it hard for the Fed chair to get up there and go, yeah, we're going to cut rates. But with that data coming out this last week, your thought is we're seeing some potential signs that relief on, not relief, that pain, I guess, on the job side, and hopefully with a inline or below print on inflation data this coming week, tomorrow, should hopefully support the Fed being able to hold rates versus hike them throughout the remainder of the year.
Correct. Yeah. The main thing that I think is going to take off the table is hikes. I don't think it's going to put much more gas in the tank for cuts. But I do think there are some things that can happen, like inflation numbers tomorrow that are going to be shown and PPI numbers continuously coming into line, that they can take a little bit off the table as far as how high rates are, maybe talking again this time next year. So that is potential, but I feel like at this point, there might even have to be a government program that steps in that subsidizes the rate so that it can be more affordable and does something like that so it can kickstart the housing market. Because without rates going down, nothing's going to change. The old saying will hold true: nothing changes if nothing changes. Rates have been high and constrictive for long enough. Consumers have told the market exactly how they feel about that with their pocketbooks. They're just not going to go out and buy at those rates. They're going to sit back and wait. And they're learning that waiting is taking much longer than anybody anticipated on Wall Street or in the real estate side.
Yeah. I mean, right now, to that point on housing, let me see if I can pull this up. I mean, we're just in front of our own eyes right now. We're just seeing U.S. housing become more unaffordable, more challenging. Let me see if I can pull up where the 30-year mortgage rate is at right now. Because as I checked last, it was the highest we've seen it in a really long time. So we're looking at 6.5 to 6.89. Depending on what you're getting, best case maybe in the low to mid fives. If you're going FHA, VAs in the six,
Jumbos, I think jumbo fixed 30 is like the best non FHA loan rate, probably 6.1, 6.12.
Yep.
And that's because you're buying, but then it balances out because you're getting a non-conforming loan, aka it's a big loan. It's probably going to be in our what in plaster, probably around 800,000, 820,000 probably.
Yeah.
That's the rate's like 40 basis points lower, but you're buying an asset that's $300,000 probably on average more expensive. So
yeah. The average 30-year fixed mortgage rate rose 3 basis points last week to 6.69, which was the highest since July of 2025. This marks the 5th consecutive weekly increase, with rates up 71 basis points since the Iran war began in late February. This comes as the 10-year Treasury, which, let's see, I think I had this up. Where did I have the 10-year? 10-year 4.7,
4.7,
which is just brutal as a borrower. So you got the 10-year Treasury, which mortgage lenders obviously use to price 30-year loans, has surged 70 basis points on the same period, driven by inflation concerns. So on a $500,000 mortgage, this increase translates to more than $200 in additional monthly principal and interest payments compared to late February, when rates briefly fell below 6% for the first time since 2022. So the 30-year fixed mortgage could get north of 7% for the first time since January of 2025. It's not anything we haven't seen.
It's been a long time.
But it makes it, and I thought I saved something in here about where month over month housing sales came in at. Let me see if I can find that, because those also, here we go. U.S. existing home sales fell 1.7% month over month. It was just an estimated, 1% decline. That was obviously worse than they expected. Previously, it was 2.4%. So it's not trending in the right direction. I mean, things are slowing down right now. The only people who are buying either have to buy or are in the higher, spectrum of earning. And there's a lot of people being left out right now. I think I even saw Jamie Dimon this last week mention something about, Gen Z is wrong to give up on the American dream. And, I think there's a lot of people that vision and picture and definition of what the American dream.
Did you see that fucking picture below?
I didn't even see that. I was like, what is that? Staring at Gen Z. It's Mel Gibson directing Jesus in the Passion of Christ, and he's all bloodied up.
Man.
So obviously, Jamie Dimon coaching up Gen Z. I mean, that's probably how a lot of people in Gen Z feel, though, right? I mean, they're coming out of college with this expensive piece of paper that's getting them 40, 50 grand a year if you're lucky starting out. And, their parents or grandparents were already working towards buying their first house at that age.
Correct.
So, I mean, and that's
potentially out of a Sears catalog. So,
and that is not something that is really even an option for many people right now.
No.
I mean, there's no way you can, unless you have parents gifting you a down payment, or you were one of those unique situations where you were earning and making money through college and saving.
I mean, look at that house for sale. I mean, right down over here. We have a house for sale in it's about a mile and a half away from my house. Decent neighborhood. I would say the median home price in the neighborhood is about $680, $700. This house is beat. I mean, remember the garage doors rolled up on the bottom. Yeah. There's no backyard. I would say they're either hoarders or drug users that have been in the house, or they inherited it and just let it go to absolute shit. $450.
Yep.
Like $450,000, and it probably needs even if you went in there and you're doing the work with your contractors, that's going to be 150 grand you got to slap into.
Yeah, I was going to say, I mean, overall construction costs are extremely expensive right now.
Yeah.
Just to go in and remodel a home. I mean, you look at the average bathroom that, back in the day when I was, flipping a lot of houses, we could get bathrooms done for, $5 to $8 grand on average. I mean, a stock bathroom nowadays, you're 12 to 15 grand at a minimum.
Mm-hmm.
That's just one bathroom. That's one little tiny room, let alone you try and redo a kitchen, you do the walls, you do the flooring, you do the light fixtures, you do trim packages. You're easily multiple, six figures, if not multiple six figures in on basic remodels nowadays. I even think I saw something along the lines of homeowners. Let me see if I can find that. Their remodeling is slowing down significantly right now as well. Where was that? Yeah, I don't know where that is in my sheet, but you got 25.2 million. Let's check this out. 25.2 million Americans under 35 years old live with their parents, which is an all-time high.
Yeah, and other thing that's starting to, there's that, and I think that's mostly Gen Z. Just there's millennials for sure.
Yeah,
a lot of Gen Z.
Yeah, but yeah,
and the stay-at-home. I saw literally an article. The stay-at-home boyfriend or husband or whatever.
I saw that was like
that's on the.
There's
that's
more
like
women in the workforce now than men.
Yes, I think that is an actual fact.
That, as of today, I saw that.
Yep, I think that's a straight up fact of the matter at this point. And so
what do you think that is a result of? Is that just?
I think that a lot of the jobs that people went to school for are organizationally driven and task orientation driven and collaboration driven. And I think overall, women do that better out the gate than men in work scenarios. I think guys get along better outside the office and women get along better inside the office because that's just the way it is, I think. I was telling my wife the other day, if I hired an executive assistant, I would probably hire a woman because of how they just are better at organizational. They just, they're better at thinking in that way than I know that I am. And so I think that is showing through in the marketplace to a degree. I think a lot of the trade jobs will continue to be dominated by males because they're just more physical and maybe messy or dirty. And I'm not saying women don't like to do that, but I think men more often like to do that or for jobs. But that's my opinion. And think about this. When you were in high school, if you were to go across the classroom, almost always, who are the highest grade earners?
Oh yeah, it was
Almost was
girls.
girls. Yeah, they're because they would study, keep good notes, and so I just think that fact is showing now in the workplace because, and rightfully so, women get the same treatment and opportunities that men had, and I think prior to that, men were afforded more opportunities than women. Just because that was kind of the old school, man runs the house, woman, or man runs the business and the finances in the house. The woman is the homemaker. I think that's just becoming more democratized.
Yeah, it's a good breakdown there.
Yeah,
we saw, the data that I thought was interesting this last week tied to the month-over-month decline in housing sales. We're seeing more generational families moving in together, which I'm actually not mad at on that trend. I think that's kind of a cool trend where you see multiple generations of family, whether it's in one house or, in best case scenario, right next to each other in the same neighborhood or on the same piece of property with an ADU or whatever it may be. But with the affordability issue being a real problem, this was a big thing that I saw a lot of people again saying this is going to support, more data that the housing market is going to collapse. The largest mortgage lender in the United States, United Wholesale Mortgage, ran by Matty A, fell to an all-time low after suffering its largest drop in history. And what do you think was the reason for that drop?
Oh, loan volume.
Yeah. I mean, that's
It's
when people are going,
science.
this is a sign that the housing market is going to crash. No, it's not. It just means that this company is less profitable right now and there's less volume of loans and demand through their customers that ultimately are getting reflected in the stock right now. And with there not being any light at the end of the tunnel in the near, short term, this is a good reaction to the data showing why people are going to maybe rotate out of an asset that is not performing well. And based on the economic climate and this particular category of asset, real estate, or the real estate industry and services tied to this industry, that their money is probably going to be better parked elsewhere.
Yep.
And especially when you've got AI earnings and you've got all the earnings that are happening. I saw on, was it the biggest earnings ever? Let me see here.
The biggest earnings ever.
Yes. So let me see here.
Hold my hand.
Hold my hand. Corporate America is currently on pace for the biggest earning beat ever recorded. S&P 500 companies are beating earnings per share estimates by an aggregate of 29.2%. So to put this into perspective, the 5-year average stands at 7%, which is already historically high. In other words, S&P 500 companies are now beating already high expectations by 4.2 times the 5-year average.
Yeah, that's I think that the underestimation on earnings was due to analysts just sandbagging them. I don't know why they did, but I thought they were going to be strong because we kept getting all these beats on the inflation numbers. So I thought that it was going to be strong, and they have passed through. Now, some of the surprises that I'm seeing are like with CoreWeave today, a huge revenue beat, even though they had a much deeper EPS share loss. That's a really good sign, because that also shows that analysts underestimated how much they could take a loss on their EPS side and still be profitable on the revenue. So that shows that their margins are better than anticipated. I'm excited for tomorrow because to see that stock, because like I said, I'm looking at the 110 number. I'm more $6 or $7 away from there, and it will.
Oh baby, come on!
It will.
Let me ride that girl into the sunset, because. And of course,
he's not even dropping words there.
No,
exactly what he was.
I'm going to treat her well. She's treating me nice. I saw that Berkshire Hathaway has begun deploying some of their 397 billion cash pile that's been sitting on the sidelines, and people have been saying they're waiting for a market crash. They're waiting for this. They're waiting for that. There's all this speculation around what is Berkshire Hathaway going to do with their cash. And as we've always said, we like paying attention to the big boys and the big girls on the block. The institutional money usually has more resources, more insights, and they're usually front running things or waiting for things. And this was one that was a head scratcher to me, because Berkshire Hathaway obviously historically has been great, but you've also said some of his investment style has been either a little bit more conservative or maybe a little bit long in the tooth and outdated to where the market has moved today. They kind of missed out on the AI run.
They didn't they really missed out on it. They don't own, they own small percentages of a lot of the companies, but they didn't go in and do.
They didn't make a big stake on anything.
No, not like they've done in, Kraft Heinz, Apple, American Express, Bank of America, Oxy. I would say that they could shave off some of their value holdings and get a few more of the tech holdings. And I think it's fair to note that Warren Buffett did publicly say, I just don't know these companies anymore, and I only buy the stuff that I understand.
Yeah.
So I'm pretty sure that was essentially a dry powder pile for the current CEO, and I forget his name off the top of my head, but his successor, the new CEO, has initiated purchasing of stock, and I think that's a good idea, and I think Berkshire A and B shareholders are going to benefit from it.
Well, Berkshire Hathaway appears to be leaning bullish again. They have one particular stock that they are betting big on, and they have begun deploying that 397 billion that he has accumulated over 14 consecutive quarters. The details included, instead of continuing stock sales, Berkshire was a net buyer of equities in Q2 with 19.8 billion in net purchases. They now hold 364.7 billion in cash and cash equivalents. And the company that they invested in, 10 billion in Alphabet, Google, during Q2, in addition to acquiring Taylor Morrison Home for 6.8 billion. That was interesting that they got into housing.
I'm not shocked. They're so diversified. They have like everything.
Yeah.
But I think that's because home builder demand is going to continuously be high and for the foreseeable future because of the lack thereof of inventory.
I think home builders are going to be set up for a generational run when rates get back in line. We saw lumber prices drop last week.
Yeah, a ton.
We've seen steel still a little bit challenging right now, but again, a lot of the materials that home builders use have started to retrace a little bit in a positive way. We've seen, if capital comes back to a reasonable level where they can build at scale, the big thing is, of course, tech is going to continue to get better. We talked about this on, a couple episodes back, right? You got robots, you've got manufactured warehouses that are literally getting, lines of homes built within hours and put out. You've got 3D printing and technology now, building little cities out of, clay tubes or spinning around and, printing up houses really quickly. I'm actually very bullish on certain home builders that have been around for a long time that are going to solve one of the largest problems on planet Earth right now, which is affordable housing. And with technology continuing to accelerate, AI continuing to accelerate, and the demand and need for this type of product, I think if capital can fall back in line, I think this might be a good investment thesis that they're, betting some money on before those types of, variables to this equation kind of fall back in line.
Yeah, that was well said. I think that rates are the linchpin for that. And I think that that's going to be
It's so damn crazy how much rates drive
cost of capital.
so much.
Cost of capital, because it touches everywhere. It's the person investing in the asset, the institution trying to get the spread on how much they're making while for lending that money. It could even go down to the cost of the equipment and the cost of the materials if rates are high, because if somebody's borrowing to get those items. So to me, that's the scary part, is that it's so easy to fix, but it's also so hard at the same time. We can see it. It's right in front of us. Rates need to be lower, but how can we get rates lower?
Let's take a quick break and hear from today's show sponsor. What if luxury homeownership in Orange County was more attainable than you thought? At Skyline OC, Orange County's tallest residential tower, you can own a designer-finished residence with resort-style amenities, breathtaking panoramic views, and a lifestyle designed for how you live, work, and invest. Whether you're building wealth through real estate or searching for your next home, Skyline OC offers exceptional value in the heart of Orange County with condos from the 600s to $3 million. Visit SkylineOCResidences.com and discover why now is the perfect time to own at Skyline OC. So another one that I had got some pre-IPO shares of that you talked about previously that a lot of people are very bullish on is Anthropic. Anthropic now is planning for an IPO sometime in September or October is what the whispers on the street are. And it's shaping up to be, of course, another blockbuster. It's got a T in front of it. That valuation is, starting to get thrown around a little bit more for these types of juggernaut companies. I think they have 1.75 trillion as their estimated IPO price and valuation. What are your thoughts on Anthropic, and how does it compare to the, multi-trillion-dollar IPO of SpaceX? Are we going to see it run and then retrace heavily like SpaceX did? Do you think that investors will sell off? How do you think this one's going to be digested in the market?
I think that it will do a similar thing to SpaceX, pop and then drop, and then people will start accumulating, and then Wall Street will give a nice price target, and we're going to start running back up to that. Anduril is the one I always get confused between the two. That's the one where I'm hoping in the next year they IPO, and I think that one is just super strong and will probably not have as much of a pullback early on, because I don't think people are going to want to sell that.
Yeah. Okay. Well, we will continue to take a look at that. Last one that I had for you was curious on your thoughts on, have you been paying attention to any of the kind of big private equity groups that are going around and doing a lot of business roll-ups and buying businesses and kind of that whole craze, right? I mean, we've seen a lot of private equity get into, and it's always been around, but it really kind of blew up. I mean, so many people were selling their companies off to, private equity that was doing a portfolio of HVAC companies and a portfolio of, fire suppression companies. And a lot of those became, especially post-COVID, seemed like it really expanded and blew up quite significantly. Right now, private equity firms are currently sitting on what seems like a ticking time bomb of over 33,000 unsold businesses. There's exactly 33,575 businesses held by private equity firms with no clear exit strategy in sight. And with borrowing costs high and M&A activity kind of starting to hit a little bit of a sluggish point, these firms are kind of stuck holding the bag on billions of dollars in assets. Is this something that could become an issue for these private equity companies?
Yes, because it would have, obviously, if you ever get stuck holding a bag, that's not a positive connotation there. It depends on each deal. It's not like a blanket for terminology. Kind of like if you ran your pro forma incorrectly and somebody ran theirs correctly. If they bake that in, they have the reserves for that, not going to be as big of a problem as somebody said the sun is always going to be shining. So I think it's going to be on a case-by-case basis. The same thing's happening on the bond side because a lot of those deals were funded with private credit, and that was a higher yielding side of the credit fixed income spread thing was really sexy for a while, and I just never did it. Bonds are already not sexy, so I just people that buy them, we just buy intermediate bonds and kind of the vanilla ones. But the the whole idea of, I'm going to get, 0.5% more for taking twice the amount of risk just never made a bunch of sense for me. And then people have been losing their ass in those fixed income areas. The spreads or their yields are rising so much because they're trying to keep up with the rising interest rates and keep a rate above that it's just killing the face on those bond values. So all these bonds are trading at a discount versus at par or at a premium. So I think it's always a good idea to not chase the shiny thing. It's really hard because the FOMO kind of kicks in, like, what if I don't do this? And what if, pretty much you're almost always going to be okay, even if you get in a little bit late, especially to investments. That you can be really bad or really bad off, though, if you get into something and you go full bore and it just doesn't pan out the way that you intend it to do.
Yeah.
The most common thing we see investors do that in is gold or crypto. Believe it or not. Safe to do in the S&P 500, not safe to do in one individual stock. Safe to do in, that's pretty much it. You shouldn't really just be in anything that's not diversified.
Yeah.
Because nobody's that smart. I wish, but nobody's that smart.
Yeah. This is why I tell people too, when you're first getting into real estate, one of the best things you can do instead of betting everything on one investment is bring on some partners. One of the best lines that was always given to me early in my investing journey is it's better own a slice of a watermelon and diversify your risk than take on 100% of the risk and own 100% of a grape.
100%.
You can really give yourself more exposure to more opportunities. Partnerships are, when done right, when documented right, when structured right, can be the greatest way to accelerate your wealth and to protect your wealth as you're building and working and getting reps. And I think that's one of the best ways that you can definitely do it in real estate investing. And as you continue to grow your wealth, you really want to think about ways that you're really protecting your wealth in the process. And diversification is one of those things that, for me, I've really had to go, dude, I know you love real estate. I know this is your core tree trunk, but like those roots are deep, but every tree's got some branches that go off of it as well and are equally as important to the ecosystem. And diversification, is something that I've really had to force myself to do and get comfortable with. And thank God I fucking did.
Yeah, no, absolutely.
Because the last few years in real estate have been challenging. I mean, I haven't bought a deal this year. I got, 2 last year, none this year. And it's because I can't find any great opportunities. And when things dry up in one area, man, I love logging into my Charles Schwab account. I love hitting up Breedwell. I love getting that text going, hey, have you seen this pop today? Have you seen? And guess what? Like, I don't get people calling me like, hey, you seen that great deal out there in real estate? No, those calls have been few and far between. The thing is, every asset class has its cycle. This is definitely a challenging season for real estate asset classes, but I know it'll come back. Just like in 2008 to 10, 11, 12, it was pretty stale and a slog in real estate. But 13, 14, 15, 16, 17, 18, it was juicy. It was nice.
Yep.
Right. And so I think that's just something that I consistently have to have. The real estate journey is long, or the investing journey is long. And you have to remind yourself of that. Like, what's in front of you today doesn't mean that's what it's going to look like for the next 5, 10 years.
Correct. And that's also same in stocks and the securities world. We gotta constantly know. I mean, think about what we own today versus what we were buying in 2020 versus what we were buying in 2015 and you keep going back and back and you just see the trend and it changes so frequently. It seems like it's going to be forever and it's exciting to be into it, but you got to keep yourself on your toes and make sure you have a little bit of everything so you're diversified so that you don't experience as much risk. And that's really how you drive alpha, at least on my side of the street, to the portfolio long term. You diversify You take risk with names, but you take educated risk and good bets. You factor invest, you sector focus. That's what we try to do for our clients.
Yeah. Okay, so let's wrap up on a little bit of real estate. We've talked about month over month sales being down. We talked about, affordability being extremely challenging right now. Um, this is something that I alluded to here earlier in the show about lumber has now traded red for 11 days straight, longest losing streak since April of 2024. Timber, no pun intended. So we're starting to see some interesting things. These are somewhat precursors to some market shifts, some turning of the tides, I guess is what you could call it. I saw we also had home prices. Check out price reductions here. We're seeing a lot more home builders reduce prices. I mean, it's almost cheaper to buy a new home from a new builder right now than it is to buy an old 20, 30, 40-year-old home that you're probably going to have some maintenance issues with or costs that you're going to have to put into it. We saw price reductions in August are the fastest read of a shifting housing demand. And with mortgage rates near 12-month highs, sales data lags months behind. Price cuts tell us today what sales won't confirm until later on in the year. There's leading data that gives you kind of the lagging results. And price reductions, 41.4% of listings had a price reduction in August. Active inventory, 1.1 million homes, which was flat. So we're not seeing some new massive influx of supply. With demand being dropped, you look at supply remaining the same and demand dropping. It's a simple supply and demand curve. We're seeing values start to come down a little bit. So that is a good sign for affordability, hopefully, in the second half of this year. New listings were 81,000, up 1% year over year. So nothing, to write home about there. Pending sales, again, roughly flat. The demand, the absorption of what's out there and what's actually getting purchased and taken off the market is down from 5 to 10% growth a few months ago. And the median list price is $399,000 across the US, which is basically flat year over year. So as he kind of noted in this post, the sequence to watch is price cuts move first. We saw that in August. Then sales and inventory, we're seeing this remain flat. And then prices a year later. So that first signal is what we're watching right now. And that could hopefully fall in line if we get into the early part of next year. And let's say the perfect storm here for real estate, and if you're somebody looking to buy a home, is inflation data continues to trend in the right direction. This Iran conflict starts to wind down.
Yep.
We start to see the job and the economic stability of the overall US economy remain somewhere where it's at right now, which I don't see that changing too much.
Yep.
And the Fed starts to hint at rate cuts. And we continue to see housing inventory be where it's at, which it's up. And we see people buying and demand remain low. That is going to lead to some of the housing prices pull back and give people entries at hopefully a time where the cost of their mortgage is going to be way cheaper in 6, 12, 18 months into the future than it is right now. And I do think we're starting to see, I said this, we're starting to see it a little bit in commercial. We're starting to see some little glimmers of hope in the housing market that I think could lead to some great opportunities for people to find entry into this American dream
I
that
think
we've
it's
been
going to
talking
be,
about.
yeah, and I think it's going to be long term, but the reason people are complaining about housing costs is because housing demand, even though people say that it's dead or whatever, it's a fallacy because then people wouldn't care about it. So people want to have a home. You have to remember there's going to be this huge gifting period of when baby boomers are passing and giving those to their kids, those houses are going to sell. Most of them are going to sell. People don't normally stay in them. That's a huge liquidation that's going to turn into a buyer's market really fast. That's around the corner. So you can get in now, or if it's a buyer's market like it was in seller's market, excuse me. Am I saying it wrong? Where they can pretty much get lots of offers. Am I saying buyer or seller's market?
Lots of offers is seller's market.
Seller's market.
Yeah.
I think it'll even be more of a seller's market because then you're gonna. Well, excuse me. I don't know. It kind of is in my head that it's going to be like a buyer and seller's market at the same time. It's weird. I know.
We know you like.
I think it's going to be it's probably going to be a seller's market then, because I think that there's so many people that are going to want these assets. And there's going to be.
It's all going to depend on the demand is dictated by the cost of borrowing. And so,
but if they're going to have cash, I think there's going to be a lot of cash buyers. People are going to be saying
there'll be a lot of trading out of one.
That's what I'm
trading
thinking.
into another, right? So that is something where you might see a lot of people that they inherit properties from parents, through estates and trusts, and
court is going to get so thick.
They either determine, do I want to cash in on this equity? And depending on the market, right? I mean, some people that are in a position to hold the asset and maybe rent it out will do so. But there is going to be a lot of people who inherit something from their family member that don't have, a strong financial position or ground to want to maintain the asset or see financial viability in keeping it. And they're going to want access to that liquidity. They always say you can't eat your balance sheet. And if people, depending on where they're at in that point in their life, need access to money, that's going to be one bargaining chip that a lot of people get passed on to them from older generations in their family. And they're going to put that money to work in the economy or with their bills or maybe buying another home, right? So I think it'll be interesting to see how that trickles into the housing market and whether or not it's something that stimulates more demand and drives more supply simultaneously, and how those things work together. Because we've never seen a tsunami like we will see with this boomer generation
100%.
With the assets that have been owned and passed on to the next generation.
On both sides. I mean, we're going to see inherited IRA distributions are nuts because I get a lot of clients with them now, and it's like 10 years you got to liquidate the thing. Client gets $1 million from mom or dad from their 401k. That's crazy. We didn't have to do that 5 or 6 years ago. So again, it's an interesting time for everything. We got tons of money going out in lots of places, lots of real estate going to come up on the market, lots of accounts that are going to get liquidated when people are like, well, if I have to take that house money out, what if I can just, put that $100K down for a house? I'm going to take it out anyway.
Yeah.
There's a lot of things that are going to change the landscape is my point.
Awesome. This is the next 20, 30 years of investing is going to look different than anything that's ever been seen in the past.
Yep.
And so that's where when you hear people trying to predict the future of investing,
it's okay to say we know it's going to be, we predict it's going to be different, and we can theorize in a positive way. But yeah, I think when people go black and white on things, you're like,
well, we're in a different tech economy. Yeah. We're in a different jobs economy. We're in a different financial state. We're in a different manufacturing and production, like the generations of the past. That I do feel like that chapter of the world is somewhat closing, and AI and tech and what people prioritize and is important to them, and how we move as societies, and what's actually available to us and how quickly it's available to us. There's just so many different variables of how people make decisions and what they value and where they put their money and how they make their money, that I think will see right now and into future generations or decades a new era of what making money and saving money and spending money all looks like. And that's going to be the fun part of it. This is something that I think is one of the greatest times ever to be an investor. And you've got more opportunity than ever. And that's why you got to be as engaged, honestly, as ever, because the X's and O's and the simple I's that you dot and the T's that you could cross in the past and build wealth, it's just different.
Yeah.
And now it's a little bit more nuanced, but it's also so much more opportunistic for the people that are leaning in and learning some of these skill sets.
And the strong will survive.
The strong will survive, and we know that will be you. So, as always, thank you guys for tuning in this week. As always, if you want to connect with Ryan and his team, we had a lot of people, whatever you said last week, there was people wanting to chat with you on. So, if you want to connect with Ryan and his amazing team regarding your investment portfolio, a free financial audit on your investments, you can text the word X-ray to 844-447-1555. For many of you who reached out on the income fund, and obviously my new series on the show or on my socials has been documenting this investment journey of building the experiential investment fund and how we're paying our investors, 10% while unlocking some other experiential components that are not out there that other funds can't offer. We are, or aren't offering, I should say. You can text the word income if you have any interest in investing and generating some passive income by partnering with us to be the bank and collecting a monthly mailbox check. So income to 844-447-1555. As always, we appreciate you guys tuning in each and every week. Keep investing in yourself and your wealth on your march to $1 million and beyond. We'll see you in the next episode. Cheers.
Cheers, y'all.